Different forms of business organization. The sole proprietorship is a type of business structure open to businesses run and owned by one entrepreneur. A large advantage of the sole proprietorship is its ease. It does not require filing of articles of incorporation, regular meetings, or election of a board. The main disadvantage of the sole proprietorship is that there is no separation between the entrepreneur and the business, resulting in personal liability for business losses and the business ceasing to exist if the proprietor dies. An entrepreneur is a person who organizes and operates a business venture and assumes much of the associated risk. A proprietor is an owner. Business organizations can be structured in two major ways, in terms of their legal entity structures and in terms of their internal structure and management processes. The sole proprietorship is a type of business structure from a legal status perspective and is open to any business run by one entrepreneur. The advantage of the sole proprietorship is its ease of filing incorporation and tax documents and having uninterrupted control of the business. Sole proprietors file taxes as personal income and have control over their businesses without the involvement of elected board members. The main disadvantage of a sole proprietorship is the lack of separation between the entrepreneur and the business, resulting in personal liability for business losses and the business ceasing to exist if the proprietor dies. Sole proprietorships often have difficulty raising long-term capital due to relying exclusively on one person. A partnership is the simplest structure open to collaborative ownership. The partnership structure offers simplicity and control, but partners are personally liable for the partnership's activities. So in simple terms, a sole proprietorship is a kind of business owned and run by one person. It's easy to start because you don't need to do a lot of paperwork or have regular meetings like bigger companies. However, the downside is that there's no separation between the owner and the business. This means the owner is responsible for any losses the business faces, and if the owner passes away, the business usually ends. An entrepreneur is someone who starts and runs a business, taking on a lot of the risks. A proprietor is simply an owner. Businesses can be organized in different ways, legally and internally. The good thing about a sole proprietorship is that it's easy to handle legal paperwork and control the business. Owners file taxes as personal income and have full control without needing a board's approval. The bad part is the owner is personally responsible for the business losses, and if the owner dies, the business often ends because there's no separation between the two. Sole proprietors might find it hard to get a lot of money for their business since it all depends on one person. A partnership is another simple structure where a few people own the business together. It's simple to start, but each partner is responsible for what the business does. Partnership structure. Pros, cons, and types. The partnership is a type of business structure open to businesses run and owned by two or more entrepreneurs. A large advantage of the partnership structure is its ease in terms of filing and tax treatment. A general partnership can be started with no special formalities. The partners are taxed individually on their respective shares of the partnership's profits. The structure's main disadvantage is that partnership owners can be personally liable for business losses. The partnership is not a separate entity from the owners/entrepreneurs, unlike a corporation. Limited partnerships and limited liability partnerships have developed to mitigate some of the disadvantages of the structure. Partnership is an association of two or more people to conduct a business. Liability refers to an obligation, debt, or responsibility owed to someone. Partnership is the simplest business structure open to collaborative ownership. Partners are taxed individually on their share of the partnership's profits. Partnership owners can be personally liable for business losses in some forms of partnership. The partnership structure is only as good as the partnership at the relational level. Types of partnerships, such as limited partnerships and limited liability partnerships, have been introduced to address some of the limitations of the structure. So in simple terms, a partnership is a type of business where two or more people own and run it together. It's quite simple to start, and there's no special paperwork needed to begin. The good thing is that partners are taxed individually for the money they make from the business. However, the main problem is that the owners can be held responsible for the business losses. In a partnership, the business isn't seen as separate from the people who own it, unlike a corporation. To fix some of these issues, there are other types of partnerships like limited partnerships and limited liability partnerships. These were made to help reduce some of the downsides of this kind of business structure. A partnership is when a few people team up to run a business together. Liability means being responsible for something, like a debt or an obligation. A partnership is the easiest way for people to own a business together. In some types of partnerships, partners might have to pay for the business losses using their own money. How well a partnership works depends on how well the partners get along. Different kinds of partnerships, such as limited partnerships and limited liability partnerships, were created to solve some of the problems of this structure. Limited liability company structure and benefits. A limited liability company LLC is a business structure in the U.S. that protects owners from personal responsibility for the company's debts or liabilities. LLCs are hybrid entities that combine the characteristics of a corporation with those of a partnership or sole proprietorship. LLCs offer limited liability to owners, similar to a corporation, and flow-through taxation, similar to a partnership. Regulation of LLCs varies from state to state. Any entity or individual can be a member of an LLC, except for banks and insurance companies. LLCs do not pay taxes directly. Profits and losses are passed through to members, who report them on their individual tax returns. LLC owners are called members. LLCs require articles of organization to be filed with the state. LLCs provide more flexibility and protection for investors compared to corporations. LLCs may choose not to pay federal taxes directly and instead report profits and losses on the personal tax returns of the owners. If fraud is detected or if a company fails to meet legal and reporting requirements, creditors may pursue the LLC members. Wages paid to members are considered operating expenses and are deducted from the company's profits. LLC formation requirements vary by state, but generally involve choosing a name and filing articles of organization. So in simple terms, in other words, a limited liability company LLC is a type of business structure in the U.S. that helps protect owners from being personally responsible for the company's debts or problems. It's a mix of a corporation's safety and a partnership's flexibility. LLCs don't pay taxes themselves. Instead, any money they make or lose gets passed to the owners, who then report it on their own tax returns. Anyone except banks and insurance companies can join an LLC. LLC owners are called members. To start an LLC, you need to file some paperwork with the state, like the Articles of Organization. The good thing about an LLC is that it offers more flexibility and protection for the people who invest in it compared to a regular company. If there's fraud or the company doesn't follow the rules, the people who own the LLC might be held responsible. Also, any money paid to the members as wages is taken out of the company's profits. Starting an LLC changes a bit depending on the state, but it usually involves picking a name and filing some paperwork. LLCs and their advantages and disadvantages. The information included in the documents for LLCs includes the names and addresses of the LLC's members, the name of the LLC's registered agent, and the business statement of purpose. The articles of organization are filed, along with a fee paid directly to the state. Paperwork and additional fees must also be submitted at the federal level to obtain an employer identification number (EIN). The primary reason business owners opt for LLCs is to limit personal liability for themselves and their partners or investors. LLCs are seen as a blend of a partnership and a corporation, offering liability protections like a corporation and a straightforward business agreement like a partnership. LLCs may have to be dissolved upon the death or bankruptcy of a member, whereas corporations can exist indefinitely. Founders looking to launch a publicly traded company may find an LLC unsuitable. The primary difference between a partnership and an LLC is that an LLC separates the business assets from personal assets, protecting owners from the company's debts and liabilities. Both LLCs and partnerships can pass through their profits and responsibility for taxes to owners. In an LLC, a business continuation agreement can ensure smooth transfer of interests when an owner leaves or dies. LLCs provide limited liability and pass through profits like a partnership, while offering some characteristics of a corporation. LLCs prevent owners from being held personally responsible for company debts and lawsuits. So in simple terms, the paperwork needed for an LLC includes details like who the LLC members are, their addresses, the registered agent's name, and the business purpose. These papers are filed with a fee paid to the state. To get an employer identification number (EIN) at the federal level, more paperwork and fees need to be submitted. People choose LLCs mainly to protect themselves and their partners or investors from being personally responsible for the business problems. LLCs are a mix of a partnership and a corporation. They safeguard owners from debts like a corporation, but work flexibly like a partnership. When a member in an LLC passes away or goes bankrupt, the LLC might have to end, unlike corporations that can go on forever. If someone wants to create a big company for the stock market, an LLC might not be the best choice. The main difference between a partnership and an LLC is that an LLC keeps business stuff separate from personal stuff. Both LLCs and partnerships pass on their profits and taxes to the owners. In an LLC, there's a special agreement that helps move the business smoothly if an owner leaves or dies. LLCs offer protection from debts and share profits like a partnership while having some features of a corporation. They stop owners from being personally responsible for the company's debts and legal problems. Comparison of LLCs and corporations. LLCs allow all profits to be passed directly to owners and taxed as personal income, avoiding double taxation like corporations. Examples of LLCs include Alphabet, PepsiCo, ExxonMobil, and Johnson & Johnson. There are variations of LLCs, such as sole proprietorship LLCs, family LLCs, and member-managed LLCs. Many physician groups register as LLCs to protect individual doctors from personal liability. LLCs have simplified taxation and a straightforward establishment process. Corporations have limited liability and perpetual life, but are more complex to establish and maintain. Incorporators must file articles of incorporation and hold organizational meetings. Corporations require annual reporting and financial statements. One advantage of corporations is the protection of personal assets. Ownership in corporations is easily transferable, and the corporation does not cease to exist with the death of shareholders, directors, or officers. So in simple terms, LLCs let owners get all the profits and pay taxes personally, so they avoid being taxed twice like corporations. Big companies like Alphabet, PepsiCo, ExxonMobil, and Johnson & Johnson are examples of LLCs. There are different types of LLCs, like ones where there's only one owner, family-run ones, and ones managed by their members. Some groups of doctors use LLCs to protect each doctor from being responsible for problems. LLCs make taxes easier and are simple to start. On the other hand, corporations have less risk for owners and can go on forever, but they're more complicated to set up and maintain. To create a corporation, the people involved need to file certain paperwork and have meetings. Corporations have to report every year and show their financial statements. One good thing about corporations is that they protect a person's things outside of the business. Also, it's easy to transfer ownership in a corporation, and the business doesn't end if someone involved passes away. Business structure and legal entities. Corporations are one type of business structure, but they are more complex to establish and maintain compared to sole proprietorships and partnerships. To form a corporation, the incorporator must file articles of incorporation and hold an organizational meeting to elect a board of directors. The structure requires annual reporting and the publication of financial statements for assessment of creditworthiness. Shareholders have limited liability but may experience a loss of privacy and are subject to double taxation. The protection of personal assets is a major advantage of the corporate structure. Ownership is easily transferable, and the corporation continues to exist even with the death of stakeholders. Corporations are generally taxed at a lower rate compared to individuals. As corporations combine the legal environment of standard corporations with federal income taxation similar to partnerships. As status allows income deductions and tax credits to flow through to shareholders, with income being taxed at the shareholder level. Certain corporate penalty taxes do not apply to S corporations. Agency conflicts can arise when the agent's incentives do not align with the principles. The agency view of a corporation focuses on these conflicts. So in simple terms, corporations are a type of business setup, but they're trickier to start and keep up compared to businesses like sole proprietorships or partnerships. To create a corporation, the person starting it has to file specific paperwork and have a meeting to choose a board of directors. Corporations have to report their activities every year and show their financial statements to prove their financial strength. People who own shares in a corporation are safe from losing more than they invested, but they might lose their privacy and could get taxed twice. The good thing about corporations is that they protect a person's belongings outside of the business. Also, it's easy to pass on ownership in a corporation, and the business keeps going even if someone involved passes away. Corporations usually get taxed at a lower rate than individuals, as corporations are like regular corporations legally, but get taxed more like partnerships. In an S corporation, the money and taxes go to the shareholders, who pay taxes on that money. Certain penalties don't apply to S corporations. Sometimes there might be disagreements between the person doing the work, the agent, and the person they're working for, the principal in a corporation. The idea of a corporation focuses on these disagreements. Understanding control systems and the principal-agent problem in corporate governance. The agency view of the corporation entrusts the decision rights control to the manager to act in the best interests of shareholders and stakeholders. This separation leads to the need for corporate governance mechanisms to align managers' incentives with those of shareholders and stakeholders. The principal-agent problem refers to the difficulties in motivating the agent-manager to act on behalf of the principal shareholders due to differing interests and asymmetric information. Moral hazard and conflict of interest can arise in the principal-agent relationship. Deviation from the principal's interests by the agent leads to agency costs, mainly due to contracting costs, separation of ownership and control, and different objectives of managers. Recent interest in corporate governance focuses on mitigating conflicts of interest between stakeholders. Key terms: agent, one who acts on behalf of another; principal, the one who directs the agent; moral hazard, the prospect of behavior change when insulated from risk. Conflicts of interest can also arise between stockholders and bondholders, leading to agency costs on the firm. So in simple terms, the way corporations work involves giving the person in charge, the manager, the power to make decisions that benefit the owners, shareholders, and others involved stakeholders. But because these groups might have different interests, there's a need for rules and systems called corporate governance to make sure the manager's goals match those of the owners and others. When the manager doesn't act in the best interest of the owners, it's called the principal-agent problem. This happens because the manager might have different information and interests compared to the owners. Problems like moral hazards, when people behave riskily because they're protected from the consequences, and conflicts of interest can come up in this relationship between the manager and the owners. If the manager doesn't look after the owner's interests, it can cost the company. These costs include the expenses of setting rules, the gap between who owns the company and who controls it, and the different goals of the managers. Recently, people are more interested in making rules that reduce conflicts of interest between those involved in the company. In this setup, the agent is the manager making decisions for others, and the principal is the person telling the manager what to do. Conflicts can also happen between different groups involved in the company, like shareholders and bondholders, which can cause expenses for the company. Conflicts of interest and stakeholders in corporate governance. Much of contemporary interest in corporate governance focuses on mitigating conflicts of interest between stakeholders. A conflict of interest arises when an individual or organization is involved in multiple interests that may compromise their ability to act in the best interest of one party. Conflicts of interest can occur among various stakeholders, including managers, shareholders, bondholders, board of directors, employees, government, suppliers, and customers. Conflicts of interest should be distinguished from corruption cases like bribe-taking or fraud. In corporate governance, three key parties are managers, shareholders, and bondholders. Managers control the corporation and make strategic decisions, while shareholders are owners and bondholders are creditors. Each of these parties has different interests, rights, and rewards. Shareholders have an incentive for riskier projects, while bondholders focus on strategies that ensure investment returns. Shareholders may also prefer higher dividend payouts. Key terms: bond, dividend, moral hazard. So in simple terms, a lot of today's focus on corporate governance aims to solve problems when different people or groups involved in a company have conflicting interests. When someone is in situations where their different interests might affect how they work for others, it's called a conflict of interest. This happens among various groups in a company like the people in charge managers, the owners, shareholders, and the creditors, bondholders. These conflicts of interest aren't the same as when someone does something wrong like taking bribes or committing fraud. In the company structure, the key players are the managers, the owners, and the creditors. Managers make big decisions for the company, owners own it, and creditors lend money to it. Each of these groups wants different things and gets different rewards. Owners might like riskier projects that could bring more money, while creditors focus on strategies that make sure they get their money back. Owners might also prefer getting more money regularly from the company. Some important terms here are bond, which is like a loan, dividend, which is a regular payment to owners, and moral hazard, which is when people take risks because they're protected from the consequences. Conflicts between managers and shareholders and agency costs in corporate governance. Much of contemporary interest in corporate governance focuses on mitigating conflicts of interest between stakeholders. A conflict of interest arises when an individual or organization is involved in multiple interests that may compromise their ability to act in the best interests of one party. Conflicts of interest can occur among various stakeholders, including managers, shareholders, bondholders, board of directors, employees, government, suppliers, and customers. Conflicts of interest should be distinguished from corruption cases like bribe-taking or fraud. In corporate governance, three key parties are managers, shareholders, and bondholders. Managers control the corporation and make strategic decisions, while shareholders are owners and bondholders are creditors. Each of these parties has different interests, rights, and rewards. Shareholders have an incentive for riskier projects, while bondholders focus on strategies that ensure investment returns. Shareholders may also prefer higher dividend payouts. Key terms: bond, dividend, moral hazard. So in simple terms, the agency view of a company says that the people who manage it should work for the benefit of the owners, but problems come up when ownership is separate from management or when managers have different goals. The big bosses like CEOs and top executives make important decisions about what the company should do, while the owners own parts of the company but let the bosses run it. Sometimes managers might make choices that suit them personally, like buying other companies to make themselves rich or changing financial numbers to get more bonuses. Corporate governance is all about giving the owners their rights, being clear about what's happening in the company, and stopping these conflicts between different interests. When the manager's actions don't match what the owners want, it's called agency costs. This often happens because the manager has their own goals or isn't being watched closely enough. It's really important to have a good system of corporate governance to make sure everything runs efficiently. The impact of corporate governance on shareholders. After high-profile corporate collapses involving accounting fraud, there has been renewed public interest in corporate governance and its impact on shareholders. Corporate governance advocates emphasize the importance of respecting shareholder rights and promoting shareholder education. Shareholders and bondholders have different rights and returns, leading to potential conflicts of interest. Shareholders, who legally own shares of stock, have an incentive to take riskier projects compared to bondholders, who are more focused on getting their investment back. Shareholders prefer higher dividend payouts, while bondholders receive interest regardless of profit. Conflicts can arise due to differences in the terms and maturity of bonds and stocks. Bondholders may put contracts in place to restrict risky projects or increase the interest rate demanded. Loan covenants can be used to manage the relationship between bondholders and management. So in simple terms, after some well-known cases of big companies doing shady accounting tricks, people are now paying more attention to how companies are run and how it affects the people who own a part of those companies. People who support good corporate governance say it's really important to make sure that the rights of those who own a part of the company are respected, and they also believe that it's a good idea for these owners to learn more about how the company works. There are different kinds of these owners. Some are shareholders who own parts of the company's stock, and others are bondholders who have given the company loans. Because they are different, they can sometimes want different things, which can lead to disagreements. Shareholders who have pieces of the company might want the company to take more risks to make more money, while bondholders who have lent money to the company mainly just want to get their money back. Shareholders usually like it when the company pays out a lot of money to them, while bondholders get a fixed amount no matter how much profit the company makes. These differences can cause problems because bonds and stocks have different rules and times for paying back. Bondholders can make agreements to stop the company from taking too many risks or ask for more money in return for their loans. They can use these agreements to manage their relationship with the company's management. Strategic financial management. Definition, benefits, and example. Strategic financial management aims to maximize shareholder value over time. It focuses on long-term gain and creating profits for the business. Tactical management, on the other hand, seizes near-term opportunities. A financial plan is strategic and looks towards achieving long-term goals. Precise objective definition, resource identification, and specific planning are necessary for strategic management. It involves managing assets and liabilities, monitoring finances, and keeping the company on track towards long-term goals. Continuous evaluation, planning, and adjustment are important to maintain focus. Strategic financial management includes assessing and managing a company's capital structure. Strategic management prioritizes long-term success over short-term positioning. Sometimes, short-term goals may need to be sacrificed for long-term objectives. So in simple terms, strategic financial management is about making choices to increase the value of the company over a long time. It's all about planning for the future and making sure the company makes a profit in the long run. On the other hand, tactical management is more about taking opportunities that come up right now. A financial plan that's strategic looks at how to reach long-term goals. To do this, you need to be really clear about what you want to achieve, figure out what resources you need, and make a detailed plan. It also involves managing the company's money, keeping an eye on its finances, and making sure it's on track to reach its long-term goals. To make sure things go as planned, you have to keep checking, planning, and making changes if needed. Strategic financial management also involves deciding how the company gets its money and what it does with it. This way of managing focuses on long-term success, even if it means giving up short-term gains sometimes. The elements and benefits of strategic financial management. Strategic financial management involves making decisions to close facilities or reduce staff to decrease operating expenses. These decisions may result in restructuring costs or other one-time items that negatively affect the company's finances in the short term, but position it better for long-term success. Trade-offs between short-term and long-term goals need to be made with stakeholders in mind, such as shareholders who may discipline management for decisions that negatively affect share price in the short term. Strategic financial management involves designing elements to maximize financial resources and use them efficiently. Common elements of strategic financial management include planning, budgeting, managing and assessing risk, and establishing ongoing procedures. Strategies may vary according to industry and sector, with fast-growing industries focusing on growth goals and slow-growing industries focusing on asset protection and expense management. The benefits of strategic financial management include maintaining long-term goals while addressing short-term challenges. So in simple terms, strategic financial management means making choices like closing down some parts of the business or reducing the number of employees to save money. These decisions might lead to one-time costs that hurt the company's finances in the short run, but they're done to make sure the company does better in the long run. You have to think about the trade-offs between what's good for the company in the short term and what's best for its future. You also need to consider the people involved in the company, like the owners, who might not be happy if these decisions make the company's value drop quickly. Strategic financial management includes plans for how to make the most of the company's money and use it wisely. It involves things like planning, making budgets, handling and reducing risks, and setting up regular ways to do things. The way a company does this can be different depending on what kind of business it is. Some businesses that are growing quickly focus on getting even bigger, while others that aren't growing so fast concentrate on protecting what they already have and managing their expenses. The good thing about strategic financial management is that it helps the company stick to its long-term goals even when there are problems in the short term. Strategic financial management and valuation. Strategic financial management involves making decisions to close facilities or reduce staff to decrease operating expenses. These decisions may result in restructuring costs or other one-time items that negatively affect the company's finances in the short term, but position it better for long-term success. Trade-offs between short-term and long-term goals need to be made with stakeholders in mind, such as shareholders who may discipline management for decisions that negatively affect share price in the short term. Strategic financial management involves designing elements to maximize financial resources and use them efficiently. Common elements of strategic financial management include planning, budgeting, managing and assessing risk, and establishing ongoing procedures. Strategies may vary according to industry and sector, with fast-growing industries focusing on growth goals and slow-growing industries focusing on asset protection and expense management. The benefits of strategic financial management include maintaining long-term goals while addressing short-term challenges. So in simple terms, strategic management is all about helping a company stay successful and steady by following its long-term plan. This plan sets the goals and the rules for the company to reach those goals. Financial management is a big part of strategic management. It involves things like cutting costs, managing risks, and making budgets. The main aim of financial management in the strategy is to make sure the company plans well for its long-term goals. One important aspect of financial management is something called valuation. Valuation means figuring out how much something, like a company or an asset, is worth. People use this to decide on things like buying or selling a business, solving disagreements, or making big decisions for the company. Getting the value right depends a lot on having good, trustworthy information about the company's finances from the past. Having reliable financial records can make a company more attractive to potential buyers, lenders, or investors. Good financial management doesn't just deal with numbers, it helps a company become more valuable and able to adapt. It's also crucial in putting plans into action and keeping an eye on how the company is doing compared to its goals. Valuation in finance is all about figuring out the worth of something, and it uses tools like analyzing financial statements and looking at future cash flows. Having solid historical financial information is really important for getting valuation right. Financial statements are official records that show a company's financial information in a clear and organized way. Financial management has different goals, and one of them is figuring out the value of things. The importance of valuation and maximizing shareholder value. Strategic financial management involves making decisions to close facilities or reduce staff to decrease operating expenses. These decisions may result in restructuring costs or other one-time items that negatively affect the company's finances in the short term, but position it better for long-term success. Trade-offs between short-term and long-term goals need to be made with stakeholders in mind, such as shareholders who may discipline management for decisions that negatively affect share price in the short term. Strategic financial management involves designing elements to maximize financial resources and use them efficiently. Common elements of strategic financial management include planning, budgeting, managing and assessing risk, and establishing ongoing procedures. Strategies may vary according to industry and sector, with fast-growing industries focusing on growth goals and slow-growing industries focusing on asset protection and expense management. The benefits of strategic financial management include maintaining long-term goals while addressing short-term challenges. So in simple terms, valuation is like figuring out the price of things like stocks, bonds, and options. People use it to decide how much to pay for something or what it's worth. This valuation thing is important for financial markets because it helps decide how much people should pay when they buy or get when they sell. It also helps when there are disagreements, like in arguments, and when businesses are bought or sold. To do this right, the people in charge need good, trustworthy financial records that show how much their business is worth. Having these records also makes the business more attractive to people who might want to buy it, lend it money, or invest in it. Financial management is about making sure a business is as valuable as possible. It does this by paying money to the people who own the business called shareholders and making sure the value of the business goes up. One way to do this is by following the rules and ideas from the Anglo-American model of corporate governance. This model cares a lot about what the shareholders want, but some people say that just focusing on what the shareholders want can hurt other people involved with the business and even make the shareholders' value go down. The value of a business in the market is worked out by taking the number of shares a company has and multiplying it by the price of each share. A principal is someone who tells another person, the agent, what to do on their behalf. Shareholders are the people who own shares in a company. Financial management is about understanding what the numbers mean in the real world and can include things like making shareholders and the market value go up. This depends on how people understand the rules and market factors, and also has to do with laws and what people want, mechanisms and roles in corporate governance. Strategic financial management involves making decisions to close facilities or reduce staff to decrease operating expenses. These decisions may result in restructuring costs or other one-time items that negatively affect the company's finances in the short term, but position it better for long-term success. Trade-offs between short-term and long-term goals need to be made with stakeholders in mind, such as shareholders who may discipline management for decisions that negatively affect share price in the short term. Strategic financial management involves designing elements to maximize financial resources and use them efficiently. Common elements of strategic financial management include planning, budgeting, managing and assessing risk, and establishing ongoing procedures. Strategies may vary according to industry and sector, with fast-growing industries focusing on growth goals and slow-growing industries focusing on asset protection and expense management. The benefits of strategic financial management include maintaining long-term goals while addressing short-term challenges. So in simple terms, in big companies where the people who own the business are different from those who run it, a problem can come up. This issue is between the top managers who make decisions and the people who own the company. There's a risk that the board of directors, who are supposed to represent the owners, might get too cozy with the managers and forget about what the owners want. Good financial management should make the people who own the company shareholders richer. Making the company more valuable in the market is tied to making the owners wealthier because the market value is what the company would sell for in a fair competition. There are different ways that companies can be run, and one of these models focuses a lot on what the shareholders want. But some people think that concentrating only on what the shareholders want might not be the best. They say it can harm others involved with the company and might not be good for the long-term value of the shareholders' investment. The main aim of financial management should be to make the company more valuable without causing problems for the people involved. Stakeholders are the people both inside and outside the company who are affected by what the business does. There's a lot of discussion about who should be seen as stakeholders. Some say that it's crucial to pay attention to other stakeholders, not just to shareholders, because it's good for the market value and has better results. Others think the most important thing is to make the company worth more without causing issues for the people involved. The significance of financial management and the stakeholder concept. Financial management professionals focus on understanding the meaning behind the numbers found in financial documents. The goals of financial management include maximizing value without negatively affecting shareholders. Corporate governance involves the relationship between a company's management, board, shareholders, and other stakeholders. Stakeholders are individuals or groups affected by an organization's activities, and they can be internal or external. Internal stakeholders include owners and employees, while external stakeholders include customers, suppliers, the government, communities, and the environment. There are debates about whether companies should prioritize shareholders' interests or consider other stakeholders as well. After the financial crisis, concerns grew about companies prioritizing shareholder value at the expense of other stakeholders. Different countries have varying views on the inclusion of stakeholders in corporate governance decisions. Some argue that considering other stakeholders can enhance overall outcomes and market value. Others believe that businesses should at least avoid causing harm and should prioritize value maximization if it does not generate harm. The financial and economic crisis of 2007 tested central banks and required swift action to limit the damage. So in simple terms, professionals in financial management focus on understanding what the numbers in financial documents really mean. They want to make sure that they increase the value of a company without causing trouble for the people who own the company. Corporate governance is all about how a company's managers, the board, the people who own the company, and others involved all work together. Stakeholders are the people or groups affected by what the company does, and they can be both inside and outside the company. Those inside the company, like the owners and the workers, are internal stakeholders. The ones outside, such as customers, suppliers, The government, communities, and the environment are external stakeholders. There's a lot of discussion about whether companies should mainly care about what the people who own the company want, or if they should also think about what other stakeholders need. After the big financial problem in 2007, there were worries that companies were only thinking about the people who own the company and not about others involved. Different countries have different opinions about whether these other stakeholders should be part of the decisions made by the company's management. Some people say that paying attention to other stakeholders can make everything better for the company and the market value. Others believe that companies should, at the very least, avoid causing problems and should aim to increase the value if it doesn't cause trouble. The financial crisis in 2007 was a big test for the main banks and needed quick action to reduce the problems it caused. The Federal Reserve's innovations in response to the financial crisis. Financial distress is deep and pervasive, requiring innovative actions from central banks. U.S. mortgage markets at the epicenter of the financial shock, impacting financial institutions. The Federal Reserve had to adapt and innovate in providing liquidity to non-bank financial institutions. Lowering short-term policy rates alone was insufficient to counter the adverse shock. Steps taken to reinforce understanding of inflation objective and provide guidance on policy interest rates. Large purchases of longer-term securities created unprecedented volumes of bank reserves. Planning underway to remove stimulus at the appropriate time. Implementation of monetary policy was straightforward before the crisis, with minimal impact on financial markets. The Federal Reserve provided liquidity to banks through daily operations and interbank funding markets. Little credit extended through the discount window before the crisis. So in simple terms, serious financial problems were widespread and far-reaching, which needed new and creative solutions from central banks. The issues primarily started in the U.S. mortgage markets, affecting financial institutions. The Federal Reserve had to change and come up with new ways to provide money to financial companies that weren't banks. Just lowering the short-term interest rates wasn't enough to handle the problems. They took steps to better understand how to control inflation and gave advice about what they'd do with their interest rates. They'd also bought lots of longer-term assets, which created a huge amount of money for banks. There are plans to take away these measures when it's the right time. Before the crisis, it was much easier for the Federal Reserve to manage money without causing too many problems in financial markets. The Federal Reserve used to help banks by giving them money every day and by helping them borrow from each other. But there wasn't much borrowing from the discount window, which is when banks borrow money from the central bank before the crisis happened. Liquidity pressures and the role of central banks during the financial crisis. Market participants during the financial crisis were uncertain about the financial strength of counterparties, future asset values, and their own capital and liquidity needs. Interbank markets became ineffective in distributing liquidity as participants sought safe and liquid assets. Banks were reluctant to borrow from the Federal Reserve due to fear of casting doubts on their financial condition. Funding markets for other institutions, such as commercial paper markets and investment banks, also experienced disruptions. Financing market disruptions threatened the availability of credit to households and businesses, leading to asset sell-offs and deepening the recession. Central banks worldwide had to adapt their liquidity facilities to address these strains. The Federal Reserve adjusted its activities by reducing the discount rate spread and providing longer-term loans to banks. The Federal Reserve also provided dollar liquidity to other central banks to ease pressures on U.S. money markets. Recognizing the intensifying crisis, the Federal Reserve realized that lending to banks alone would not be sufficient. So in simple terms, during the financial crisis, people in the market were unsure about how strong other financial companies were, what their assets might be worth later, and what they themselves needed in terms of money and safety. The way banks were helping each other with money called interbank markets wasn't working well, because everyone wanted things that were safe and easy to turn into cash. Banks were worried about asking for money from the Federal Reserve because they thought it might make people question how financially healthy they were. This made it hard for other types of financial companies, like those in the commercial paper markets and investment banks, to get the money they needed too. Because of these problems, it became tough for regular people and businesses to get loans, and this made the economic situation even worse. Central banks around the world had to change the way they were giving money to help with these problems. The Federal Reserve did things like reducing how much banks had to pay to borrow money and lending them money for longer times. They also gave dollars to other countries' central banks to make it easier for U.S. markets to get the money they needed. As things got worse, the Federal Reserve saw that only helping banks wouldn't be enough to fix the problems. The Federal Reserve's response to the financial crisis and the role of securitization. The Federal Reserve created emergency liquidity facilities to meet the funding needs of key non-bank market participants during the financial crisis. Financial markets have shifted from banks to securities markets in recent decades, with the assistance of investment banks. Securitization has played a major role in this shift, where loans are converted into securities and sold to investors in global capital markets. Serious deficiencies in securitizations, derivative instruments, and the structures holding securitized debt were at the heart of the crisis. Banks became dependent on liquid markets to distribute loans, and some loans were sold to off-balance sheet entities with short-term borrowing funded by banks. Securitization markets collapsed during the crisis when banks were unwilling to increase their exposure to risks and other lenders became unwilling to supply credit. The Federal Reserve's lending actions during the crisis were based on clear legal and economic foundations, including the authority in Section 13 of the Federal Reserve Act. The actions adhered to Walter Bagehot's principle of lending early and freely to solvent institutions at a penalty rate and against good collateral. Central banks are uniquely equipped to carry out this mission and provide liquidity during financial panics when market functioning is severely impaired. So in simple terms, during the financial crisis, the Federal Reserve made emergency plans to give money to important companies in financial markets that weren't banks. In recent times, financial markets have changed from being mostly about banks to also including securities markets, thanks to help from investment banks. One big part of this change was securitization. This is when loans are changed into investments and sold to people in the global money markets. The problems in this process, as well as issues with other complex financial tools, were a major reason for the crisis. Banks started depending on easy-to-access markets to give out loans. They also sold some loans to other companies that didn't show up on their financial statements. These companies borrowed money for short times from banks to buy these loans. But when the crisis happened, these markets for selling loans broke down. Banks didn't want to take more risks, and other lenders didn't want to give out more loans. The Federal Reserve's way of lending money during the crisis followed the laws and made sense economically. They did this based on a part of the Federal Reserve Act and ideas from a person called Walter Bagehot. Bagehot said that during a crisis, it's important to give money early and without many limits to companies that can pay it back, but they should pay a bit extra and give good stuff as security. Central banks are the best at doing this kind of thing and providing money in tough times when the financial markets aren't working well. Central bank lending and the role of emergency liquidity facilities. Central banks provide liquidity to solvent institutions against illiquid collateral, assuming the risk of fire sale prices. Central banks do not supply capital directly, as that is a fiscal function. The Federal Reserve and Treasury established the term Asset-Backed Securities Loan Facility (TLF) to restart securitization markets. The Federal Reserve lent to stabilize Bear Stearns and AIG with the support of the Secretary of the Treasury. Studies evaluating the effectiveness of emergency liquidity facilities are ongoing, but anecdotal evidence suggests they improve financial conditions. The TLF helped improve asset-backed securities (ABS) markets and credit availability to firms and households. U.S. dollar funding market pressures have reduced. So in simple terms, central banks help out healthy companies by giving them money, but they take things as security that might not be easy to sell quickly if there's a crisis. They accept the risk of having to sell things at low prices if things go really bad. However, central banks don't give out money for a company to invest directly, as that's the job of the government. The Federal Reserve and the Treasury made something called the term Asset-Backed Securities Loan Facility (TLF) to help get the markets where loans are turned into investments back on track. During the crisis, the Federal Reserve lent money to keep Bear Stearns and AIG stable, with help from the Treasury Secretary. People are still studying whether the emergency money given out by central banks actually helped, but early reports suggest that it made things better in the financial world. The TLF program played a part in improving the markets for investment made out of loans and also made it easier for businesses and regular people to get loans. the pressures in the U.S. market for borrowing money in dollars have also gone down. Federal Reserve's experience in the financial crisis and lessons for handling future liquidity disruptions. The spread between Libor London interbank offered rates and OIS overnight index swap rates decreased, and there was also a decline in premiums paid for U.S. dollars in foreign exchange swap markets. The term auction facility, which auctioned discount window credit to depository institutions, and liquidity swaps between the Federal Reserve and foreign central banks, helped to provide liquidity to commercial banks. Usage of emergency liquidity facilities decreased as conditions in financial markets improved, and the programs were successfully closed without losses to the Federal Reserve. The funding markets remained somewhat vulnerable, as evidenced by the reemergence of strains in U.S. dollar short-term funding markets in Europe. Lessons for handling future liquidity disruptions include allowing the Federal Reserve to lend against good collateral to other regulated financial institutions when necessary, while limiting moral hazard by providing credit only to tightly regulated and supervised groups of institutions. The Federal Reserve should have an ongoing and collaborative relationship with the supervisor of institutions potentially receiving emergency discount window credit to ensure conservative liquidity policies are maintained. So in simple terms, the gap between Libor London interbank offered rates and OIS overnight index swap rates got smaller, and the extra cost for getting U.S. dollars in foreign exchange swap markets also went down. To help commercial banks, there was something called the term auction facility, where they could bid for discounted money from the central bank. Liquidity swaps between the Federal Reserve and other countries' central banks also gave banks more money to work with. As things got better in financial markets, the use of these emergency money programs went down, and they were closed successfully without losing money for the Federal Reserve. However, there were still some issues in the markets where money is borrowed for short times in U.S. dollars in Europe, showing that things were still a bit shaky. The reduction of the policy interest rate, combined with emergency liquidity facilities and liquidity swaps, led to a decline in the cost of funds in money markets. Event studies indicate that the expected path of policy rates moved down substantially after the introduction of the extended period language in March 2009. So in simple terms, the FOMC's use of the phrase exceptionally low for an extended period helped to keep long-term interest rates lower than they might have been otherwise. To help people understand what's going on, the Federal Reserve started giving more predictions and explaining those predictions. They began doing this more often in late 2007. In January 2009, policymakers also started sharing what they thought would happen in the long term with economic growth, inflation, and unemployment. This extra information about long-term inflation helped people feel more sure about what was going to happen to prices during the crisis. Just by lowering the short-term interest rates and giving people an idea of what to expect, the Federal Reserve couldn't completely solve the big economic problems caused by the financial crisis. Once the usual interest rate reached zero, the Federal Reserve tried different ways to help the economy. They started buying a lot of government and other types of securities. They bought a huge amount of Treasury securities, agency debt, and agency mortgage-backed securities. This meant there was a lot more money in the banking system. These steps helped to lower the amount of money people and businesses had to pay to borrow. By reducing the main interest rate and providing emergency money to banks, the cost of borrowing money in different markets also went down. After the FOMC started talking about the extended period in March 2009, studies show that people's ideas about what interest rates were going to do went down a lot. Interpretation and effects of Federal Reserve's policies on interest rates and market expectations. Market participants see extended period language as stronger than for some time in reference to federal funds rate remaining low. Extended period language doesn't prevent interest rates and market expectations reacting to economic information, but does have a slight effect. Purchasing longer-term assets and expanding the reserve base and banking system have less understood economic effects. Question about direct effects of large-scale asset purchases. Purchasing longer-term assets pushes up prices of securities, lowering their yields, but extent and duration of effect is uncertain. Relying on event studies to analyze impact of purchases on interest rates. Effectiveness of purchases is difficult to quantify. Uncertainty regarding how purchases put downward pressure on interest rates. Some argue market effect comes from total amount purchased. Others argue it comes from flow of purchases relative to new issuance. Recent evidence suggests stock channel is primary driver of market effect. Large volume of reserves created as assets are purchased. Focus has been on effects of purchases on asset prices and related assets. Creation of bank reserves is seen as a byproduct. So in simple terms, the use of the term extended period in relation to keeping the federal funds rate low is seen as more forceful compared to saying for some time. However, this language doesn't stop interest rates and what people expect from changing based on economic news. It does have a small effect, though. When central banks buy assets that take a longer time to give a return and increase the amount of money banks have, the impact on the economy is not completely understood. There's a question about what the direct effects of buying a lot of these long-term assets are. When central banks buy these long-term assets, it makes the prices of those things go up, which then lowers how much profit they make. But how big this effect is and how long it lasts is not very clear. Researchers have been looking at past events to see how much buying these assets has affected interest rates. But it's tough to say exactly how much these purchases help. There's uncertainty about how these purchases actually push interest rates down. Some say it's about how much was bought, while others argue it's about how much was bought compared to what was newly made available. Recent evidence shows that it's the big volume of money available in banks that makes the biggest difference to the market. People have mostly been focused on how these purchases affect the prices of these assets and other related things. The fact that a lot of money is created in banks because of these purchases is seen as a side effect. Conducting monetary policy in a crisis. Market participants see extended period language as stronger than for some time in reference to federal funds rate remaining low. Extended period language doesn't prevent interest rates and market expectations reacting to economic information, but does have a slight effect. Purchasing longer-term assets and expanding the reserve base and banking system have less understood economic effects. Question about direct effects of large-scale asset purchases. Purchasing longer-term assets pushes up prices of securities, lowering their yields, but extent and duration of effect is uncertain. Relying on event studies to analyze impact of purchases on interest rates. Effectiveness of purchases is difficult to quantify. Uncertainty regarding how purchases put downward pressure on interest rates. Some argue market effect comes from total amount purchased. Others argue it comes from flow of purchases relative to new issuance. Recent evidence suggests stock channel is primary driver of market effect. Large volume of reserves created as assets are purchased. Focus has been on effects of purchases on asset prices and related assets. Creation of bank reserves seen as a byproduct. So in simple terms, basic models and money experts suggest that if you add more money to the system, people should spend more. However, this hasn't worked well recently. Banks are behaving like they're following a standard rule where they want to hold on to as much money as possible when interest rates are almost zero. We're not sure how buying a lot of long-term assets will affect what people expect prices to do in the future. People have been pretty confident that prices won't go crazy for the last few years, even with the unusual things the Federal Reserve has been doing. If a promise is made to keep interest rates at a certain level, it needs to be based on how the economy is doing. The Bank of Canada changed how long it will keep interest rates low because the situation is changing. This shows that interest rate promises need to be flexible. The Federal Reserve says how long they'll keep interest rates low depends on how well the economy is doing, how prices are behaving, and other factors. The importance of firmly anchored inflation expectations. Firmly anchored inflation expectations are crucial for successful monetary policy. Central banks have not followed the recommendation to raise inflation targets to avoid hitting the zero lower bound. Increasing inflation targets could result in more variable inflation and worse economic outcomes over time. It may take a long learning process for households and businesses to adjust to the new targets, just as when inflation trended down in recent decades. A higher inflation target may lead to more persistent inflation as businesses and households take inflation into account when making decisions. Raising inflation targets could make expectations more sensitive to recent realized inflation and other economic conditions, reducing the ability of central banks to buffer the economy from shocks. No major central bank has raised its inflation target in response to the recent financial crisis. Large-scale asset purchases at the zero bound help ease financial conditions and reduce longer-term yields. Low rates on mortgages and corporate bonds support demand, stabilize the housing market, and strengthen the financial condition of firms. Central banks should also consider the potential effects on inflation expectations of expanding their balance sheet. So in simple terms, it's really important that people have a good idea about how prices will change in the future for money-related decisions to work well. However, central banks haven't gone along with the suggestion to increase their goals for how much prices should go up to avoid problems when interest rates are at the lowest they can go. If they were to increase these goals, it might mean that prices change a lot more and the economy might not do so great over time. It could take a while for regular people and businesses to get used to these new goals, just like it took time for them to adjust when prices were going down in recent years. Having higher goals for how much prices should go up might mean that prices stay high for longer because businesses and people will start to expect prices to go up more when they make decisions. If these goals for how much prices should go up are increased, people might start paying more attention to how prices have changed recently and other economic stuff. This might make it harder for central banks to help the economy when unexpected things happen. None of the big central banks have increased their goals for how much prices should go up after the recent financial crisis. When central banks buy a lot of assets and interest rates are already as low as they can go, it helps make things easier for borrowing and makes it cheaper for big loans. This helps with people buying houses and companies getting money to do stuff. Central banks also need to think about how making their collection of assets bigger might affect what people think will happen to prices in the future. The Federal Reserve's policy tools and approach to financial stability. Firmly anchored inflation expectations are crucial for successful monetary policy. Central banks have not followed the recommendation to raise inflation targets to avoid hitting the zero lower bound. Increasing inflation targets could result in more variable inflation and worse economic outcomes over time. It may take a long learning process for households and businesses to adjust to the new targets, just as when inflation trended down in recent decades. A higher inflation target may lead to more persistent inflation as businesses and households take inflation into account when making decisions. Raising inflation targets could make expectations more sensitive to recent realized inflation and other economic conditions, reducing the ability of central banks to buffer the economy from shocks. No major central bank has raised its inflation target in response to the recent financial crisis. Large-scale asset purchases at the zero bound help ease financial conditions and reduce longer-term yields. Low rates on mortgages and corporate bonds support demand, stabilize the housing market, and strengthen the financial condition of firms. Central banks should also consider the potential effects on inflation expectations of expanding their balance sheet. So in simple terms, the amount of money the Federal Reserve keeps on hand can be used to help the economy. But there's a worry that having a lot of this money available could make people think prices will go up more. The Federal Reserve is always watching how prices change, and if it looks like prices might get a lot higher, that's a big worry for them. Banks need ways to undo any unusual things they've done and make sure people don't start to expect prices to shoot up just because of what the bank did. The Federal Reserve has ways to control how much money is available, like paying banks for keeping extra money, or using new methods to move money around when needed. Keeping interest rates low for a long time could create problems with money and investments, but it's not clear if changing money-related plans should fix this, along with keeping prices stable and people employed. Instead of changing money plans, it might be better to have rules and oversight to deal with money and investment problems. But sometimes, changing money plans might be used in specific situations. Different types of financial institutions. Firmly anchored inflation expectations are crucial for successful monetary policy. Central banks have not followed the recommendation to raise inflation targets to avoid hitting the zero lower bound. Increasing inflation targets could result in more variable inflation and worse economic outcomes over time. It may take a long learning process for households and businesses to adjust to the new targets, just as when inflation trended down in recent decades. A higher inflation target may lead to more persistent inflation, as businesses and households take inflation into account when making decisions. Raising inflation targets could make expectations more sensitive to recent realized inflation and other economic conditions, reducing the ability of central banks to buffer the economy from shocks. No major central bank has raised its inflation target in response to the recent financial crisis. Large-scale asset purchases at the zero bound help ease financial conditions and reduce longer-term yields. Low rates on mortgages and corporate bonds support demand, stabilize the housing market, and strengthen the financial condition of firms. Central banks should also consider the potential effects on inflation expectations of expanding their balance sheet. So in simple terms, people who control money have a tough job keeping prices and the economy stable in today's financial markets. We really need to have a good talk about these important questions to make sure things stay safe and steady in finance. Different financial companies offer services like taking and lending money, as well as different investment options. Some of these companies specialize in certain services for specific customers. There are different types of financial companies, like central banks that watch over all the other banks, banks for regular people and businesses, online banks, credit unions, investment companies, and others like insurance and mortgage companies. Central banks, like the Federal Reserve in the U.S., keep an eye on all the other banks. Regular banks offer things like accounts, loans, and credit cards for both people and businesses. Online banks do the same things as regular banks, but they're on the internet. Types of financial institutions and their services. Internet banks. Consumers can carry out banking services online through computers, mobile devices, ATMs, or customer service lines. Depositing checks can be done by taking a picture of the check using a phone and the bank's app. Credit unions, nonprofit financial institutions owned and operated by their members. Initially served specific demographic groups but now open to the general public with minimal requirements. Can offer reduced fees and better interest rates than banks. Savings and loan associations provide checking accounts, personal loans, and home mortgages. Owned by customers or the community, aims to lend for residential mortgages. Investment banks act as intermediaries in complex transactions, such as IPOs and mergers. Help raise capital through the issuance of securities. Brokerage firms assist individuals and institutions in buying and selling securities. Can trade stocks, bonds, mutual funds, ETFs, and alternative investments. Insurance companies help individuals and businesses transfer the risk of loss. Covered death, disability, accidents, property damage, etc. can include self-insurance programs of other financial institutions. Mortgage companies specialize in originating or funding mortgage loans, serve both individual and commercial real estate markets. So in simple terms, internet banks, these are banks you can use online. You can do your banking on a computer, phone, ATM, or by calling their customer service. You can even deposit a check by taking a picture of it with your phone using the bank's app. Credit unions, these are special banks that are owned and run by the people who use them. Originally, they were just for certain groups, but now they're open to anyone with only a few requirements. They often have lower fees and better interest rates than regular banks. Savings and loan associations, these places offer checking accounts, personal loans, and home mortgages. They're owned by their customers or the community and focus on giving out home loans. Investment banks, these banks help with complex money transactions, like when companies go public IPOs or when they merge. They also help companies get money by selling things like stocks and bonds. Brokerage firms, these companies help people and businesses buy and sell investments. They can deal with things like stocks, bonds, mutual funds, and other types of investments. Insurance companies, they're there to help individuals and businesses deal with the risk of losing money due to things like death, accidents, property damage, and more. They might also manage insurance plans for other financial institutions. Mortgage companies, these companies are experts in providing or funding loans for buying homes. They work with both regular people and businesses in the real estate market. Overview of financial institutions and markets. Financial intermediaries, such as banks and funds, act as middlemen between parties in financial transactions, potentially reducing costs. Banks make money through fees and interest earned from loans, like mortgages and personal loans. Banks and credit unions are generally safe due to federal insurance coverage. Cryptocurrency exchanges fall under the regulatory scope of the Bank Secrecy Act and must comply with anti-money laundering and terrorism financing obligations. There are 8 major types of financial institutions that provide various services. Financial markets come in different types, including general and specialized, capital and money, and primary and secondary. Financial markets refer to the markets used for buying and selling financial securities, commodities, and other fungible items. So in simple terms, financial middlemen, companies like banks and funds, help people do money-related deals, making things cheaper sometimes. Banks make money. Banks get money from the fees they charge and from the interest they earn on loans, like home loans and personal loans. Banks are safe. Banks and credit unions are usually safe because they're covered by government insurance. Cryptocurrency exchanges. These follow rules to stop money-related crimes, like money laundering and financing terrorism, and are overseen by laws like the Bank Secrecy Act. Types of financial companies. There are 8 main types of companies that offer different money services. Different financial markets. These markets vary. Some are general, some are specific, some deal with big investments, others with smaller ones, and some are where things are first bought and sold, while others deal with already owned stuff. What financial markets are? Financial markets are where people trade things like stocks, goods, and other easily exchangeable items. Overview of financial markets and their functions. Financial intermediaries, such as banks and funds, act as middlemen between parties in financial transactions, potentially reducing costs. Banks make money through fees and interest earned from loans, like mortgages and personal loans. Banks and credit unions are generally safe due to federal insurance coverage. Cryptocurrency exchanges fall under the regulatory scope of the Bank Secrecy Act and must comply with anti-money laundering and terrorism financing obligations. There are 8 major types of financial institutions that provide various services. Financial markets come in different types, including general and specialized, capital and money, and primary and secondary. Financial markets refer to the markets used for buying and selling financial securities, commodities, and other fungible items. So in simple terms, financial markets for raising money. These markets help gather money. There are 2 types: long-term markets for big money needs and short-term markets for smaller, quick needs. Long-term money. Capital markets. These markets, like the stock market and bond market, gather big amounts of money by selling shares like pieces of ownership and bonds, which are loans. Primary and secondary markets. In the long-term markets, primary markets are where new shares or bonds are first sold, while secondary markets are where these things are traded later on. Different types of financial markets. There are other markets too, like derivatives, things whose value depends on something else, in currency markets where different money values are decided. Derivatives in currency markets. Derivatives are like bets on values of other things, while currency markets deal with exchanging money and deciding its worth. What financial markets do? These markets help move money from people who have it to those who need it. They match up the savers and the borrowers. Importance of financial markets in allocating capital. Financial markets allocate capital by matching those who have capital to those who need it. Capital markets facilitate the raising of long-term capital, while money markets facilitate the transfer of short-term liquidity. Financial markets attract funds from investors and channel them to enterprises for financing and growth. Money markets allow firms to borrow funds for general operating expenses and to cover periods of illiquidity. Capital markets allow corporations to gain long-term funding to support expansion and investment in physical capital goods. Financial capital is used by entrepreneurs and businesses to buy necessary resources for their products or services. Without financial markets, borrowers would struggle to find lenders. So in simple terms, matching people with money to those who need it, financial markets help connect people who have money to spare with those who need it. Long-term and short-term needs. Some markets help with getting big money for long-term plans, capital markets, while others help with quick money needs, money markets. Getting money from savers to businesses, financial markets collect money from investors and direct it to businesses for their growth and financing. Quick money for everyday costs. Money markets help businesses borrow money for daily expenses and when they need cash fast. Big money for big plans. Capital markets let companies get long-term money to grow and invest in things like buildings and equipment. Money for businesses to get resources. Entrepreneurs and businesses use this money to buy what they need for their products or services. Why financial markets matter? Without these markets, it would be hard for people who need money to find those willing to lend it. Financial markets and their role in providing feedback to management. Financial markets function through the interaction of buyers and sellers, determining the price of traded assets and allocating funds based on demand and supply. Management often seeks feedback on their business, and market research is one way to gain insight into customers' wants and needs. Financial markets also provide feedback to management by showing the perceived financial value of a company compared to its competitors. Investors who hold shares in multiple firms in a sector may have more information about the prospects in that sector than a single firm's manager. Information asymmetry, where one party has more or better information than the other, is a concept economists study in transactions, including financial markets. So in simple terms, how financial markets work. Financial markets are like big marketplaces where people buy and sell things like stocks and bonds. The prices of these items go up and down based on how much people want to buy and sell them. The market decides who gets money based on what people want and what's available. Feedback for business. Business leaders often want to know how they're doing, and one way to understand their customers' needs is through market research. They ask questions and gather information to make their products or services better. Feedback from financial markets. Financial markets also give feedback to businesses. By looking at how much people are willing to pay for a company's stocks or bonds, the market shows how much they think that company is worth compared to its competitors. More information from investors. Sometimes, investors who own shares in several companies within an industry have a better understanding of that industry than the manager of a single company. They can see the bigger picture. Information differences. Economists study something called information asymmetry, which is when one party knows more or better things than the other party. This comes into play in financial markets and other transactions. The Securities Act of 1933 and information asymmetry in financial markets. The stock market is prone to oscillation due to positive and negative feedback resulting from cognitive and emotional factors among market participants. The feedback from the stock market can vary in usefulness for managers making short-term and long-term decisions. The Securities Act of 1933 aims to provide investors with complete and accurate information before they invest. The Act requires issuers of public securities to disclose material financial and corporate information. Registration forms for securities offerings call for descriptions of the securities, information about the issuer's management, information about the securities being offered, and certified financial statements. Rule 144 allows for the sale of restricted and controlled securities without registration under specific circumstances. Regulation this provides a safe harbor for offerings executed in another country and exempt from registration requirements. Private placements are funding rounds of securities sold through a private offering to a small number of selected investors. The U.S. Securities and Exchange Commission (SEC) is responsible for enforcing federal securities laws and regulating the securities industry in the United States. The Securities Act of 1933 is a consumer protection law for retail investors that aims to provide them with complete and accurate information about issuers of public securities. Securities offered to the public in the U.S. must be registered with the SEC unless they qualify for an exemption. So in simple terms, stock market changes. The stock market goes up and down because people's thoughts and feelings affect how they buy and sell. Sometimes it's positive, sometimes negative. Usefulness for managers. The information from the stock market can be useful for managers when they're making short-term or long-term decisions for their companies. Securities Act of 1933. This law from 1933 is meant to help people who invest money. It makes sure that investors get the right and full information before they put their money in. Information needed. The law says companies offering stocks to the public must share important financial details, info about their management, and their financial reports. Rules for selling stocks. There are specific rules like Rule 144 that allows selling certain stocks without following all the registration rules under certain conditions. Regulations for international offers. Regulation S gives safety rules for selling stocks in other countries without needing to register in the U.S. Private sales. Private placements are when companies sell stocks to a small group of special investors. Securities and Exchange Commission (SEC). This is the group that makes sure everyone follows the rules about selling stocks and protects people who invest money. Protection for investors. The Securities Act is a law to help regular people who invest, making sure they get all the right information before buying stocks. Registration for public offerings. Usually stocks offered to the public in the U.S. need to be registered with the SEC unless there's an exemption. Securities Act and Rule 144. The law requires the registration of offers and sales of securities, rather than just the registration of securities themselves. If person A sells securities to person B must either file a registration statement or find an exemption if they want to resell those securities. Many transactions are exempt from regulation under the Securities Act, which primarily applies to public offerings by issuers and underwriters, not transactions between investors or small group sales. The prospectus, included in the registration statement, markets an issuer's securities to potential investors. Registration forms require a description of the securities, information about the issuer's management, information about the securities if not common stock, and certified financial statements. For public offerings, the main requirement is registration, which involves preparing a detailed statement approved by the SEC and placing its data in a prospectus. Rule 144 allows the sale of restricted and controlled securities without registration under specific conditions. Form 144 must be filed with the SEC if requirements are met, and a legal opinion may be required. Limitations for securities sold in any subsequent 3-month period include 1% of the stock outstanding, average weekly reported volume of trading, or average weekly volume of trading reported through NASDAQ. Notice of resale must be provided to the SEC if securities sold in reliance on Rule 144 exceed 5,000 in any 3-month period. So in simple terms, laws say that when you want to sell financial investments to others, you need to officially tell the government about it. If someone buys these investments from you and wants to sell them again, they also have to tell the government or find a special exception to do so. However, not all sales need to follow these strict government rules. The document that talks about these investments to potential buyers is called a prospectus, and it has details about what's being sold, who's selling it, and how well the business is doing financially. When a company wants to sell its investments to the public, it needs to create a detailed document approved by the government and share this information in the prospectus. There's a rule called Rule 144 that allows the sale of certain investments without needing the government's approval, but there are specific conditions to meet. If these conditions are met, a specific Form 144 must be given to the government, and sometimes a legal expert's opinion might be needed. When using Rule 144, there are restrictions on how much can be sold within a 3-month period. If you sell more than a certain amount, you have to inform the government about it. So in simpler terms, the government needs to know when investments are being sold, especially for public sales, but there are rules and exceptions to this, and limitations on how much can be sold without their approval. Securities Exchange Act of 1934 and Regulation S. Rule 144 allows for the permanent removal of restrictions on shares or securities with an aggregate sales price over $50,000 after 1 year, except for insiders. Owners of securities who wish to sell restricted and controlled securities in cases of mergers, buyouts, or takeovers must refile Form 144 once the transaction is completed. Regulation S is a safe harbor that defines when an offering of securities is deemed to be executed in another country and not subject to registration under the 1933 Act. Regulation S includes an issuer safe harbor and a resale safe harbor, requiring offers and sales to be made outside the United States without directed selling efforts. The Securities Exchange Act of 1934 governs the secondary trading of securities in the United States, regulating financial markets and participants. It covers securities exchanges like NYSE, MX, and regional exchanges, as well as broker-dealers. The Maloney Act amended the Exchange Act in 1938 and authorized national securities associations to supervise their members under SEC oversight. Brokers have developed alternative trading systems ATS as a quasi-exchange for trading securities. NASDAQ, or the National Association of Securities Dealers Automated Quotations, is an electronic stock market. So in simple terms, Rule 144 is a rule that lets you remove restrictions on selling certain shares or securities if they're worth more than $50,000 and you've held on to them for at least a year. But this rule doesn't apply to people who are considered insiders of the company. If you own securities and want to sell them after a merger, buyout, or takeover, you have to fill out a form called Form 144 once the deal is done. Regulation S is like a set of rules that say if you're selling securities in another country and not trying to attract American buyers, you don't have to register with the U.S. government. It has two parts, one for the company selling the securities and another for people reselling them. You just need to make sure you're not actively promoting the sale in the United States. The Securities Exchange Act of 1934 is a law that controls how trading of securities works in the United States. It covers places like the New York Stock Exchange and NYSE and broker-dealers. The Maloney Act, passed in 1938, changed the Securities Exchange Act. It allowed national securities groups to supervise their members while still being watched by the SEC. Brokers have also created something like their own mini-stock exchanges called Alternative Trading Systems ATS. Lastly, NASDAQ is an electronic stock market where people trade securities. It's short for the National Association of Securities Dealers Automated Quotations. Securities and Exchange Act of 1934 and its regulations. The Securities and Exchange Act of 1934 is a comprehensive piece of legislation that forms the basis for financial market regulation in the United States. The Act established the Securities and Exchange Commission (SEC) as the primary enforcement agency for federal securities law. The Securities Exchange Act of 1934 regulates stock exchanges, brokers, dealers, and private traders, focusing on secondary trading of securities. Securities exchanges, such as the New York Stock Exchange and the American Stock Exchange, are subject to regulation under the Act. Specialists in the Securities Exchange act as intermediaries to facilitate trading and provide liquidity. The Act also regulates broker-dealers, including those operating through the NASDAQ system. The Maloney Act of 1938 authorized the formation of self-regulatory organizations, FROs, leading to the establishment of the National Association of Securities Dealers (NASD). Brokers have created alternative trading systems, ATS, for trading securities outside of traditional exchanges. So in simple terms, the Securities and Exchange Act of 1934 is a big law that sets the rules for how financial markets work in the U.S. It created the Securities and Exchange Commission (SEC), which is like the main police for laws about buying and selling investments. This law controls how stock markets, brokers, dealers, and regular people who trade investments work, especially when they're buying and selling investments that have already been bought. Once this is called secondary trading. Big stock markets like the New York Stock Exchange have to follow the rules in this law. People called specialists help with trading on these markets and make sure there's enough buying and selling happening. The law also keeps an eye on broker-dealers, even the ones working through the NASDAQ system, which is an electronic market. Another law in 1938 called the Maloney Act allowed groups to watch over themselves, leading to the creation of the National Association of Securities Dealers (NASD). Brokers have also made their own systems for trading investments outside of the usual stock markets. Securities regulations and the Sarbanes-Oxley Act. ATS alternative trading systems are niche markets with low trading volumes and controlled by a few brokers or dealers. Reg ATS requires these small markets to register as a broker or exchange or operate as an unregulated ATS under certain trading caps. The 33 Act requires issuers to provide timely information about themselves for effective pricing of securities, but the disclosure requirement is one time. The 34 Act extends the disclosure requirement to securities traded in the secondary market, with regular filing of company information. The 33 Act contains an anti-fraud provision, but questions remained about its reach and private right of action under the 34 Act. The Sarbanes-Oxley Act sets new standards for public company boards, management, and accounting firms. SOX introduced individual certification of financial information by top management and increased penalties for fraud. It increased the independence of outside auditors and the oversight role of boards of directors. It was enacted after major corporate and accounting scandals, aiming to improve confidence in financial statements. Opponents claim it has reduced America's competitive edge, while proponents argue it has improved investor confidence. Key terms include boards of directors, off-balance sheet activities, and conflicts of interest. So in simple terms, ATS, which stands for Alternative Trading Systems, are small markets where not many trades happen, and only a few brokers or dealers control them. These markets have to follow certain rules. Regulation ATS makes these small markets register as a broker or exchange, or they can operate as an unregulated ATS, but only if they don't do too many trades. The 33 Act says that when companies want to sell their investments to the public, they have to give some important information about themselves. However, they only need to do this once. The 34 Act makes companies keep sharing information about themselves regularly if their investments are being traded by others in the secondary market. The 33 Act has a rule against fraud, but there were questions about how far it could be used and whether people could sue under the 34 Act. The Sarbanes-Oxley Act, known as SOX, made new rules for how big companies are managed and how their finances are handled. It made top managers personally vouch for the financial information, increased penalties for fraud, and made sure that the people checking the company's finances are independent and report to the company's board. SOX came after some big scandals involving companies and their finances. Its goal was to make people trust company financial statements more. Some people say SOX has made the U.S. less competitive, while others say it has made investors trust companies more. Important terms related to this include boards of directors, off-balance sheet activities, and conflicts of interest. The Sarbanes-Oxley Act of 2002. The Sarbanes-Oxley Act of 2002 is a federal law that set new or enhanced standards for public company boards, management, and public accounting firms in the United States. It is also known as the Public Company Accounting Reform and Investor Protection Act and the Corporate and Auditing Accountability and Responsibility Act. The act was named after sponsors U.S. Senator Paul Sarbanes and U.S. Representative Michael G. Oxley. SOX requires top management to individually certify the accuracy of financial information and imposes severe penalties for fraudulent financial activity. It increased the independence of outside auditors and the oversight role of boards of directors. The act was enacted in response to major corporate and accounting scandals, including those affecting Enron, Tyco International, Adelphia, Peregrine Systems, and WorldCom. SOX-type laws have been subsequently enacted in other countries. Title I of SOX provides independent oversight of public accounting firms and creates a central oversight board, the PCAOB. Title II establishes standards for external auditor independence and addresses requirements for auditor approval, rotation, and reporting. Title II mandates senior executives' responsibility for the accuracy and completeness of corporate financial reports. Title IV describes enhanced reporting requirements for financial transactions and requires internal controls for financial reports. Title V addresses measures to restore investor confidence in the reporting of securities analysts. Title VI defines practices to restore investor confidence in securities analysts and the authority of the SEC. So in simple terms, the Sarbanes-Oxley Act of 2002 is a law in the U.S. that made new rules for how big companies operate, how they manage their finances, and how their financial statements are checked. It's also known by a few other names like the Public Company Accounting Reform and Investor Protection Act or the Corporate and Auditing Accountability and Responsibility Act. The law is named after two politicians, Senator Paul Sarbanes and Representative Michael G. Oxley, who sponsored it. Sarbanes-Oxley Act, or SOX, says that top managers of big companies must personally confirm that their financial info is accurate. If they lie or do something fishy with money, they can get in big trouble. SOX also made sure that the people checking the company's money are more independent, and it made company boards have more responsibility in checking on what's happening financially. This law was made because there were some really big scandals involving companies and their money, like Enron, Tyco International, Philadelphia, Peregrine Systems, and WorldCom. The Sarbanes-Oxley Act has different parts that cover things like overseeing the firms that check a company's money, Title I, setting rules for these checkers, Title II, making top company executives responsible for their financial reports, Title II, asking for more detailed reports about financial deals, and making sure the companies have good controls for their money, Title IV, restoring trust in people who get advice about buying or selling investments, Title V, and defining good practices for these advisors, and the authority of the Securities and Exchange Commission, SEC, Title VI. Summary of the Securities Exchange Act of 1934 and the Insider Trading Act of 1988. Title VI of the Securities Exchange Act of 1934 requires studies and reports by the Comptroller General and the SEC. Title VII of the Act describes specific criminal penalties for manipulation of financial records and provides protections for whistleblowers. Title X increases criminal penalties for white-collar crimes and adds failure to certify corporate financial reports as a criminal offense. Title X states that the CEO should sign the company tax return. Title XI of the Act is the Corporate Fraud Accountability Act of 2002, which identifies corporate fraud and records tampering as criminal offenses. The Insider Trading Act of 1988 expanded that SEC scope to enforce insider trading laws and increased liability penalties for all involved parties. The act was signed into law by Ronald Reagan and came into being due to the increase in high-profile insider trading cases. There have been notable cases of insider trading since the passage of the Insider Trading Act, including the Martha Stewart Imclone case. So in simple terms, Title VI of the Securities Exchange Act of 1934 tells the government and a special agency to do studies and write reports. Title VII of the Act talks about strict punishments for messing with financial records and makes rules to protect people who report wrongdoing. Title X makes the penalties tougher for people who commit certain financial crimes and says that not confirming accurate financial reports is a criminal offense. Title X says the head of a company, the CEO, has to sign the company's tax return. Title XI, called the Corporate Fraud Accountability Act of 2002, says that faking company records and cheating financially are serious crimes. There's also the Insider Trading Act of 1988, which widened the power of a government agency called the SEC to stop insider trading. This law increased the penalties for everyone involved in these illegal trades. This law was made by Ronald Reagan because there were more and more cases of important people using secret information to trade stocks illegally. One famous case after this law was about Martha Stewart and the company Imclone. Insider trading, imprisonment, and fines. Insider trading can result in imprisonment and fines. The SEC can impose monetary penalties in multiples of the profit generated from insider trades. Jail time can be up to 10 years, depending on the severity of the crime. Fines are capped at either 300% of the profit or $1 million, whichever is larger. Notable cases of insider trading include Martha Stewart's involvement in the Imclone case and Brett Kennedy's insider trading related to Amazon's earnings. Insider trading occurs when individuals use non-public information to buy or sell stock and increase their wealth. The New York Stock Exchange implemented disclosure requirements for dividends in 1914. The Securities Exchange Act of 1934 advanced laws related to the disclosure of transactions of company stock. The SEC recently charged a CEO and his friend with insider trading for sharing confidential merger details, resulting in trading profits of $164,260. So in simple terms, insider trading means buying or selling stocks using secret information, and it can lead to serious consequences like going to jail and paying big fines. The SEC, a government agency, can make people pay back the money they made from these illegal trades. People who do insider trading could be sent to prison for up to 10 years, and they might have to pay fines. These fines could be as much as 3 times the profit they made, or up to $1 million, whichever is more. Some well-known cases of insider trading involve Martha Stewart in the Imclone case and Brett Kennedy's insider trading connected to Amazon's earnings. These individuals use secret information to trade stocks and make money. Back in 1914, the New York Stock Exchange started making rules about sharing information on dividends. In 1934, the Securities Exchange Act set more rules about how companies should share details about their stock transactions. Recently, the SEC accused a CEO and his friend of insider trading. They shared secret information about a company merger, and they made over $164,000 in profit from trading stocks using this secret knowledge. Redmond and Signarastri's violations of fiduciary duty and insider trading. Redmond disclosed confidential corporate information to Signarastri, violating his duties of trust and confidence to Genentech. Signarastri purchased Genentech stock using non-public information obtained from Redmond during negotiations, and later purchased additional stock during negotiations with American Securities LLC. Genentech announced its acquisition by American Securities 2 business days after Signarastri's last stock purchase, causing the stock price to surge by nearly 40%. Signarastri tendered all of his Genentech shares to obtain illicit profits. Redmond and Signarastri agreed to pay over $324,000 to settle the SEC's charges. That SEC's complaint states that other individuals also purchased Genentech stock using confidential information from Redmond. A waiter and a restaurant manager similarly tendered their Genentech shares after the sale announcement, resulting in combined profits of $6,162. Redmond agreed to pay disgorgement of $149,139 in other fees, while Signarastri agreed to pay disgorgement of $21,283 and other fees. Redmond will be barred from acting as an officer or director of a public company for 5 years. Redmond and Signarastri neither admit nor deny the charges against them. So in simple terms, Redmond shared secret company information with Signarastri, breaking his promise to keep that info private. Signarastri used this secret info to buy Genentech stock while they were discussing business. Later, during talks with American Securities LLC, Signarastri bought more Genentech stock. 2 days after Signarastri's last stock buy, Genentech announced it was being bought by American Securities. This news made the stock price jump up by almost 40%. Signarastri sold all the Genentech shares he had to make illegal profits. To settle the charges brought by the SEC, a government agency, Redmond and Signarastri agreed to pay more than $324,000. The SEC also mentioned that others bought Genentech stock using Redmond's secret info. A waiter and a restaurant manager did the same thing, making a combined profit of $6,162. Redmond agreed to pay back $149,139 in other fees, while Signarastri agreed to pay back $21,283 in other fees. As a consequence, Redmond won't be allowed to be an executive or board member in a public company for 5 years. Redmond and Signarastri didn't say they were guilty, but also didn't say they were innocent. Different forms of business organization, pros and cons of sole proprietorship and partnership. The sole proprietorship is a type of business structure that is open to businesses run and owned by one entrepreneur. Advantages of sole proprietorship include its simplicity, as it does not require filing articles of incorporation, regular meetings, or a board election. Taxes are filed as personal income. Disadvantages of sole proprietorship include unlimited liability, meaning the entrepreneur is personally liable for business losses, and the business ceases to exist if the proprietor dies. Partnership is a structure open to collaborative ownership and offers simplicity and control, but also personal liability for the partnership's activities. So in simple terms, a sole proprietorship is a way of doing business where one person runs and owns the business. The good thing about it is that it's easy to set up, and you don't have to do a lot of paperwork. When it comes to taxes, you just report the business income as your own. But the downside is that if the business has debts, you're responsible for paying them, and if something happens to you, the business ends. A partnership is when 2 or more people own and run a business together. It's also simple to start, and you have control over the business. However, just like in a sole proprietorship, you're personally responsible for the business's debts. Partnership structure and types. The sole proprietorship is a type of business structure that is open to businesses run and owned by one entrepreneur. Advantages of sole proprietorship include its simplicity, as it does not require filing articles of incorporation, regular meetings, or a board election. Taxes are filed as personal income. Disadvantages of sole proprietorship include unlimited liability, meaning the entrepreneur is personally liable for business losses, and the business ceases to exist if the proprietor dies. Partnership is a structure open to collaborative ownership and offers simplicity and control, but also personal liability for the partnership's activities. So in simple terms, a partnership is a way for more than one person to start a business together. The good thing is that it's not complicated to set up, and the way you handle taxes is pretty simple. You don't need to go through a lot of formalities to start a general partnership, and each partner pays taxes on their share of the profits. But there's a downside. If the business loses money, the partners can be personally responsible for those losses. In a partnership, the business and the owners are not separate. To deal with this, there are different types of partnerships that help protect the partners from these disadvantages. Limited partnerships allow some partners to have limited responsibility for the business's debts, especially if they're not involved in managing it. Limited liability partnerships also provide some protection against personal liability. Understanding limited liability company LLC structure and benefits. A limited liability company LLC is a business structure in the U.S. that protects owners from personal responsibility for the company's debts or liabilities. LLCs combine characteristics of a corporation with those of a partnership or sole proprietorship. LLCs have the limited liability feature of a corporation, but also allow flow-through taxation to the members, similar to a partnership. Regulation of LLCs differs from state to state. LLC owners are called members and can be individuals, corporations, foreigners, foreign entities, or other LLCs excluding banks and insurance companies. LLCs do not directly pay taxes on profits. Instead, profits and losses are reported on the individual tax returns of the members. LLCs require articles of organization to be filed with the state and provide more flexibility and protection for investors compared to corporations. If fraud is detected or legal/reporting requirements are not met, creditors may go after LLC members. Wages paid to members are considered operating expenses and are deducted from the company's profits. Forming an LLC involves choosing a name and documenting articles of organization with the state. So in simple terms, a limited liability company LLC is a type of business structure in the U.S. that shields owners from being personally responsible for the company's debts or problems. LLCs are a mix of a corporation's liability protection and a partnership or sole proprietorship's simplicity. They offer the protection from debts that corporations have, but they also let the company's profits and losses pass through to the owners, similar to a partnership. The rules for LLCs can be different from one state to another. People who own LLCs are called members, and they can be individuals, companies, people from other countries, foreign companies, or even other LLCs with some exceptions like banks and insurance companies. LLCs don't directly pay taxes on their profits. Instead, the profits and losses are reported on the individual tax returns of the members. To create an LLC, you need to file some paperwork called Articles of Organization with the state. LLCs give you more flexibility and protection for your investments compared to corporations. However, if someone detects fraud or if you don't follow the legal and reporting rules, creditors can go after the LLC's members. Any money paid to members as wages is considered an operating expense and is subtracted from the company's profits. Creating an LLC involves picking a name and filling out the required documents with the state. Information and advantages/disadvantages of LLCs. The articles of organization are filed, along with a fee paid directly to the state. Paperwork and additional fees must be submitted at the federal level to obtain an Employer Identification Number (EIN). LLCs are registered to limit personal liability of owners and partners/investors. LLCs are a blend of a partnership and a corporation, offering certain liability protections. LLCs may have to be dissolved upon the death or bankruptcy of a member, unlike corporations. LLCs may not be suitable for founding a publicly traded company. LLCs separate business assets from personal assets, protecting owners from debts and liabilities. Both LLCs and partnerships pass through profits and are taxed as part of owners' personal income. LLCs can use a business continuation agreement for smooth transfer of interests. LLCs prevent owners from being held personally responsible for company debts. So in simple terms, when you start an LLC, you need to fill out some forms and pay a fee to the state. You also have to do some paperwork and pay extra money to the federal government to get an employer identification number EIN. LLCs are set up to protect the people who own and invest in the business. They're like a mix of a partnership and a corporation, which means they provide certain legal protections to the owners. However, if a member of an LLC dies or goes bankrupt, it might lead to the LLC having to close down, unlike corporations, which can keep going. Also, if you want to create a company that's traded on the stock market, LLCs might not be the best choice. One good thing about LLCs is that they separate the business's stuff from the owner's personal stuff. This helps protect the owners from the business's debts and problems. Both LLCs and partnerships let the profits go through to the owners, and they get taxed as part of the owner's personal income. If you want to make it easy to transfer ownership in an LLC, you can use something called a business continuation agreement. It helps keep things smooth when someone wants to sell their part of the business. So in simple terms, LLCs are a way to run a business that keeps the owners from being personally responsible for the business's debts and offers some legal protections, but there are some rules and restrictions to keep in mind. LLCs and corporate structures. LLCs allow all profits to be taxed as personal income, avoiding double taxation of both the company and its individual owners. Examples of LLCs include Alphabet parent company of Google, PepsiCo Incorporated, ExxonMobil Corp., and Johnson & Johnson. LLCs can come in variations such as sole proprietorship LLCs, family LLCs, and member-managed LLCs. Many physicians groups are registered as LLCs to protect individual doctors from personal liability for medical malpractice awards. Limited liability companies are taxed differently than corporations, with LLC profits being taxed only once as part of investors' personal income. LLCs provide beneficial features such as simplified taxation and a straightforward establishment process. Corporate structures have advantages of limited liability and perpetual life, but are more complicated to found and maintain compared to sole proprietorships and partnerships. Incorporators of corporations must file articles of incorporation and hold an organizational meeting to elect a board of directors. Corporations require annual reporting and the maintenance of financial statements. One advantage of the corporate structure is the protection of personal assets for stockholders, directors, and officers. Ownership in a corporation is easily transferable, and the corporation continues to exist even after the death of shareholders, directors, or officers. Key terms: liability, incorporate. LLCs are a way to run a business where all the money you make is only taxed once as your own personal income. This avoids a situation where the company's money is taxed, and then the owner's money is taxed again. Big companies like Alphabet, which owns Google, PepsiCo, ExxonMobil, and Johnson & Johnson use this structure. So in simple terms, LLCs can have different forms, like ones where a single person owns it, family-owned ones, or ones where the members all manage it together. Many groups of doctors use LLCs to protect themselves from being personally responsible if something goes wrong in their medical practice. Compared to corporations, which are another way to run a business, LLCs have easier tax rules and are simpler to set up. Corporations offer some advantages, like protecting the owner's personal things from business problems and being able to keep going even if some people involved with the company pass away. But they are more complicated to start and maintain. When you create a corporation, you have to fill out some documents called Articles of Incorporation, and you need to have a meeting to pick the people who will run the company. Corporations also have to give annual reports and keep financial records. One good thing about corporations is that it's easy to transfer ownership, and the company can keep going even if some of the people involved are no longer there. Important words to remember are liability, which means who's responsible for problems, and incorporate, which is the process of creating a corporation. Different business structures and their pros and cons. Business organizations can be structured in various ways, both as legal entities and in terms of internal structure and management processes. The corporation is one type of business structure. Cons of a corporation include the complexity of founding and maintaining it, such as filing articles of incorporation, electing a board of directors, and annual reporting requirements. There is also the issue of double taxation, where the corporation is taxed on its profits and shareholders are taxed on their earnings. Pros of a corporation include the protection of personal assets, limited liability for stockholders, directors, and officers, and easily transferable ownership. Corporations are generally taxed at a lower rate than individuals in the United States. As corporations combine the legal environment of standard corporations with federal income taxation similar to that of partnerships. The income, deductions, and tax credits of an S corporation flow through to shareholders annually. Payments to shareholders by the corporation are distributed tax-free to the extent that the distributed earnings were previously taxed. Certain corporate penalty taxes do not apply to an S corporation. Agency conflicts can occur when the incentives of the agent and principal do not align. So in simple terms, there are different ways to set up and run businesses, including how they're legally organized and how they're managed. One way to structure a business is as a corporation. Corporations have both good and not so good things about them. The not so good parts include that they can be a bit complicated to start and keep going. This involves filing special documents, picking a group of people to make decisions the board of directors, and doing regular reports. One tricky thing about corporations is something called double taxation. This means the company gets taxed on its profits, and then the people who own shares in the company shareholders also get taxed on the money they make. But corporations offer some important benefits. They help protect the personal stuff of the shareholders, directors, and officers from business problems. Ownership in a corporation can also be easily passed from one person to another. In the United States, corporations usually pay taxes at a lower rate than individuals. There's also something called an S corporation, which is like a mix between a regular corporation and a partnership when it comes to taxes. The money the S corporation makes and the taxes it pays are passed through to the shareholders every year. Plus, the money the shareholders get from the corporation isn't usually taxed again if it was already taxed before. One more thing to know is that in corporations, there can be conflicts when the people running the company, the agents, and the people who own it, the principals, don't have the same interests. The principal-agent problem and corporate governance. The decision rights control of the corporation are entrusted to the manager to act in shareholders' interests. Control systems in corporate governance help align managers' incentives with those of shareholders and stakeholders. The principal-agent problem refers to difficulties in motivating one-party agent to act on behalf of another principal, with different interests and asymmetric information. Moral hazard and conflict of interest arise from the principal-agent problem. Agency costs result from the deviation of the agent from the principal's interest and include contracting costs, separation of ownership and control, and different objectives of managers. Recent interest in corporate governance focuses on mitigating conflicts of interest between stakeholders. Key terms: agent, principal, moral hazard. The principal-agent problem arises due to the separation of decision rights in the corporation. Agency costs occur when the agent deviates from the principal's interest. Conflicts of interest can also arise between stockholders and bondholders in a firm with debt, leading to agency costs. So in simple terms, in a corporation, the person who manages the company has the authority to make decisions on behalf of the people who own shares in the company. This is done to work in the best interests of those shareholders. To make sure everything runs smoothly and fairly, there are control systems in place that help make sure the manager's goals match those of the shareholders and other stakeholders. However, sometimes there can be problems when the manager and the shareholders have different interests or don't have the same information. This is called the principal-agent problem. It can lead to issues like moral hazard, where the manager might take risks because they don't bear the consequences, and conflicts of interest when the manager's interests clash with those of the shareholders. When the manager doesn't act in the best interests of the shareholders, it leads to agency costs. These include things like the expenses of making and enforcing contracts, the fact that the manager doesn't own the company, so there's a separation between ownership and control, and that managers may have different goals than the shareholders. Lately, there has been a lot of attention on corporate governance, which means making sure things are fair and ethical in the corporate world. This focus is about finding ways to reduce conflicts of interest among the different people involved in the company. So the key things to remember are the principal agent problem when the manager doesn't act in the best interests of the shareholders, agency costs, the costs that come with this problem, and conflicts of interest when different parties have conflicting interests. Conflicts of interest and key parties in corporate governance. Corporate governance is concerned with mitigating conflicts of interest between stakeholders. A conflict of interest arises when an individual or organization is involved in multiple interests that may hinder their ability to act in the best interests of one party. Conflicts of interest can occur between managers, shareholders, and bondholders, as well as other stakeholders such as the board of directors, employees, government, suppliers, and customers. Conflicts of interest should not be confused with corruption cases like bribery or fraud. Three key parties in the corporation's functioning are managers, shareholders, and bondholders. Managers control the corporation and make strategic decisions. Shareholders are owners of the company. Bondholders are creditors. Each party has different rights and rewards, such as voting rights or financial return. Shareholders have an incentive to take riskier projects, while bondholders are more interested in strategies that ensure the return of their investment. Shareholders may also prefer that the company pay more dividends. So in simple terms, corporate governance is all about making sure there are fair rules to reduce conflicts of interest among the people involved in a company. A conflict of interest happens when someone or a group is caught between different interests, which might stop them from making the best choices for one side. These conflicts of interest can show up between the managers who run the company, the people who own shares in its shareholders, and those who've lent money to the company bondholders. Conflicts can also pop up between other groups like the board of directors, employees, the government, suppliers, and customers. It's important to know that conflicts of interest aren't the same as corrupt stuff like bribery or fraud. They're more about trying to make sure everyone's interests are balanced and treated fairly. In a company, there are three key groups: managers who make big decisions, shareholders who own the company, and bondholders who are like creditors. Each of these groups has different rights and rewards. For example, shareholders might want to take more risks to earn more money, while bondholders want to make sure they get their money back, so they prefer safer strategies. Shareholders might also want the company to pay out more money as dividends to them. So, corporate governance is about finding the right balance between all these different interests to make sure the company works well for everyone involved. Conflicts between managers and shareholders in corporate governance. Agency costs occur when ownership is separated or when managers have objectives other than shareholder value maximization. CEOs and top executives make high-level policy and strategy decisions, while shareholders own shares of stock and can cede control rights to managers. Conflicts of interest can impact managers' decisions, such as buying other companies to expand power or manipulating financial figures for personal benefit. Contemporary corporate governance aims to respect shareholders' rights and promote disclosure and transparency. Agency costs arise when an agent's behavior deviates from a shareholder's interest, often due to contracting costs or personal objectives. Shareholders typically concede most control rights to managers, while managers must balance benefiting shareholders with conflicts of interest. Current corporate governance goals include eliminating conflicts of interest between shareholders and evaluating the efficiency of governance systems. So in simple terms, agency costs happen when there's a separation between the people who own the company shareholders and the people who make big decisions for the company managers. Sometimes the managers might have different goals than making sure the shareholders earn the most money. The top executives, like the CEO, are the ones who make important decisions about the company's direction, while the shareholders own shares in the company and give up some control to the managers. But when there are conflicts of interest, it can affect the decisions managers make. For example, they might buy other companies to boost their own power or fiddle with the financial numbers to benefit themselves. In today's world of corporate governance, the goal is to respect the rights of the shareholders and make sure things are open and clear. They want to get rid of the conflicts of interest between the shareholders and check if the way the company is managed is efficient. So agency costs arise when the manager's actions don't match up with what's best for the shareholders. These costs can be because of things like making and enforcing contracts or personal goals that don't align with the shareholders' interests. The main challenge in corporate governance is to find a good balance between giving managers some control while keeping an eye on potential conflicts of interest. Corporate governance and its impact on shareholders' welfare. After high-profile corporate collapses involving accounting fraud, there is renewed interest in corporate governance and its impact on shareholders' welfare. Advocates of governance emphasize respect for shareholder rights and the need for transparency and disclosure. Shareholders and bondholders have different rights in financial returns, leading to potential conflicts of interest. Shareholders own shares of stock in the corporation, while bondholders are the firm's creditors. Shareholders have an incentive for riskier projects, while bondholders prioritize strategies that ensure the return of their investment. Bondholders may put contracts in place to limit risky projects or raise interest rates, affecting the company's cost of capital. Other conflicts arise from the difference in maturity between bonds and stocks. Shareholders have voting rights, while bondholders do not. Bondholders' interest payments are guaranteed regardless of company profits, whereas shareholders' dividends depend on profits. Loan covenants can be used by bondholders to control risky projects. So in simple terms, after some big corporate scandals involving dishonest accounting, people are paying more attention to corporate governance and how it affects the well-being of the shareholders. Those who support better governance stress the importance of respecting the rights of shareholders, being open and clear about what's going on, and giving them all the information they need. It's important to know that shareholders who own parts of the company and bondholders who've lent money to the company have different rights and ways of making money. This can lead to situations where their interests clash. Shareholders own shares in the company, and they want to make more money, even if it means taking some risks. On the other hand, bondholders have given the company a loan, and they just want to make sure they get their money back, so they prefer safer strategies. To protect themselves, bondholders might set up rules called loan covenants to limit risky projects or ask for higher interest rates, which can affect how much it costs for the company to borrow money. There are also differences in how quickly bonds and stocks are paid back. Shareholders can vote on company matters, while bondholders usually can't. Bondholders get interest payments no matter what's going on with the company's profits, while shareholders only get dividends if the company is making money. So it's all about finding a balance between the interests of shareholders and bondholders and making sure the company is doing well for both. Corporate governance and its impact on shareholders' welfare. After some big corporate scandals involving dishonest accounting, people are paying more attention to corporate governance and how it affects the well-being of the shareholders. Those who support better governance stress the importance of respecting the rights of shareholders, being open and clear about what's going on, and giving them all the information they need. It's important to know that shareholders who own parts of the company and bondholders who've lent money to the company have different rights and ways of making money. This can lead to situations where their interests clash. Shareholders own shares in the company, and they want to make more money, even if it means taking some risks. On the other hand, bondholders have given the company a loan, and they just want to make sure they get their money back, so they prefer safer strategies. To protect themselves, bondholders might set up rules called loan covenants to limit risky projects or ask for higher interest rates, which can affect how much it costs for the company to borrow money. There are also differences in how quickly bonds and stocks are paid back. Shareholders can vote on company matters while bondholders usually can't. Bondholders get interest payments no matter what's going on with the company's profits, while shareholders only get dividends if the company is making money. So it's all about finding a balance between the interests of shareholders and bondholders and making sure the company is doing well for both.